Xin kính chào quý vị khán giả. Hello Viet TV Canada. Welcome to the Wealth Expert Show, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huynh. Last week, we discussed the differences between the business structures of sole proprietorship, partnerships, corporations, and focused on the tax and liability advantages of corporations. We left off discussing the various strategies of taking money out of your business tax-free using the capital dividends account, which is basically your business's unlimited TFSA account. First, using capital gains, which flows 50% of the gains to your CDA. This episode, we will discuss using a specialized life insurance policy to flow virtually 100% of the funds out of the business tax-free, which will be the difference of receiving $9 million instead of $2.5 million for your family and loved ones, as you will see in our example. Although it is a life insurance policy, this special policy is primarily used for retirement purposes and is often referred to as a corporate insured retirement policy. Let me show you why. This policy, unlike regular life insurance, is composed of two cash flows. Firstly, the death benefit, which is the amount of money your loved ones will receive on your death. Secondly, the cash surrender value, which is the amount of money which builds tax-free within the policy. The cash surrender value, or CSV, has two components, the guaranteed portion and the dividend payout. The guaranteed portion is a yearly guaranteed cash payment which the insurance company pays into the cash surrender value account. The dividend portion is a payment which the insurance company pays into the cash surrender value account based on their profits for that year, which is highly correlated to interest payments. So the higher the interest rates are in the market, the higher your dividend payments. You will want to look for companies that are consistent in their dividend payments year over year. Generally, you should be able to find companies that are currently paying out 6 to 6.5% based on today's interest rate. And as interest rates rise in the future, you can expect your CSV account to grow even faster. Those are two benefits over capital gains. Firstly, the policy acts as a tax shelter, so your CSV is able to grow year over year without being taxed. Secondly, your CSV grows at a consistent rate year over year with very little volatility or fluctuation. Accessing the funds from the policy for retirement can be done in two efficient methods. Firstly, collapsing the policy, meaning you're canceling the policy and taking the entire CSV. There will be some tax implications depending on how long you've held the policy for. Secondly, and more tax efficiently, is collateralizing the policy and taking a loan against it with the banks. Banks will generally allow you to borrow up to 90% value of your CSV account at a preferred interest rate as it is a secured loan, quite similar to taking a line of credit against your house. You can either pay the interest each year, which is recommended, or allow the interest to add up, in which case the life insurance will pay off the interest and loan upon your death. Be sure to speak to your advisor or myself to ensure that delaying interest payments until death is the most efficient method, as this involves some calculations. If business is great and you don't need to access the funds in your policy, then upon death, approximately the entire portion of the CSV is added to the original death benefit and will flow out to your CDA account, which passes on to your shareholders. So be sure to add your loved ones as non-voting shareholders to ensure that your hard-earned money passes on to them. At this point in time, you may be thinking that this is way more complicated than it's worth. But this simple restructuring of your assets is the difference between $2.5 million and $9 million as your net worth after taxes on death. That is a big difference. Let's walk through an example. In scenario A, you have $100,000 in every year in the business to invest in funds, as in our example from last episode. Over a 20-year period, that's $2 million in your business. But through wise investing, you've grown it to $4 million. After 20 years of working in the business, you retire and you live off the proceeds of investing the $4 million. At a 3% return, you will have a yearly salary income of $120,000. Not too shabby. Upon death, for your loved ones, who must be shareholders of your company, to access the money, they will need to withdraw it as a dividend at a 39% tax rate, meaning that $4 million is now only $2.5 million. That's one scenario. In scenario B, you have the same $100,000 every year in the business to invest. However, instead of investing the full $100,000 in funds, you invest $50,000 in funds and $50,000 into a corporately insured retirement policy. Over the same 20-year period, the $50,000 a year becomes $1 million, and since you invested it wisely, it grows to $2 million. The other $50,000 a year into the corporately insured retirement policy over a 20-year period also grew to $2 million in your cash surrender value account. Getting the same 3% return on the $2 million from funds and the $2 million from your policy, your retirement income is the same $120,000 yearly. The difference comes in at death. On death, the $2 million from the funds is taxed at 39%, which is now only $1.2 million. The corporately insured retirement policy has a total death benefit of $8 million, which is $2 million from the CSV account and $6 million from the original death benefit. Virtually most of the $8 million total death benefit passes through your business's CDA account and comes out tax-free to your loved ones, meaning your loved ones now receive a total of just over $9 million after taxes rather than $2.5 million, simply through a more efficient structuring of your business's investments. This is just one of the few strategies we can employ with corporations. More for you business owners in our future episodes. I look forward to all of your email questions. Have a topic you would like me to discuss on the show? Need a financial plan done for you and your family, or just want some investment advice? Contact me at any time at mitch@wealthexpert.ca. Thank you to all of our viewers and see you on Viet TV's Wealth Expert Show. This is Mitchell Huang, your wealth expert, signing off until next time. See you then. Bye for now.